What changed?
Nothing. Right, if you give us a few moments, clearly something in the technical side isn't collaborating with us, and we will be with you in a few moments. Don't you just love Imperial sometimes? Centre left? No. Centre all? You sure it's this cable?
Yeah, this is it.
Have you got a USB stick?
No.
It says no signal though.
Nothing gonna change.
Send it to here.
Yeah. It works for them.
Oh, wait, what?
No, this is for the big one. Because it says it works. Alright, what you'll do, so I'll tell you what to do.
Log into your house.
So what you'll do, oh no, send it to that. I get it, and then
Let me just check it's a correct one.
well, I'll put it on the other side. Yeah, you can send it now. Yeah. Oh, still got music actually. Okay, that's fine. All right, do you want to go? Right. Ready? So, welcome to session number 3. Just checking if actually things work on this side. If it doesn't work, I'll just use standard mouse. So, welcome to session number 3. So, my name is Ahmed, and I will be taking you through the first half of today's session regarding crypto financial instruments and exchange APIs. In the meantime, help yourself to an Amazon code worth £10. First one to claim it, claims it, and if you're late, you're late. So we'll just take a few moments there, assuming someone claims it, and then we'll crack on as appropriate. Right. So, how do I switch the slide? So far the course is like so. I've already done the bit to Python. It's doing quite well. And we've also just released, I've also just released my updated version of the notebook, including object-oriented programming and a bit of functions. So that's going so well. And Imran last week did...
Are you recording?
Am I recording? Should be. Check. Yeah, there. And this time we're doing a bit of financial instruments and some algo trading with Naman, who will show up momentarily. As with the pizza, it will again show up at 7:15, as Domino's clearly don't have any drivers right now. That's what they say, not that I believe them. So, yeah, we'll have an extra session on macroeconomics.
Share your screen.
Share my screen, right. I've just realised. There we go. That should be all sorted on that front. So, here are some QR codes for today's lecture 1, lecture 2, and some GitHubs. So we'll give you 60 seconds so you can acclimatise to the relevant code. I'd recommend you send it to yourself if you're scanning on phone, and then you can open it on WhatsApp web or something equivalent if you're in person. Just 1 second. Oh, there we go. That's been fixed. So, I'm going to start talking about derivatives. So if you were in the investment society, you'll remember I gave a lecture on derivatives. Went fairly well. Now I'm no longer part of that society. Relief for me. So derivatives are essentially what the subject of today's question is, lecture is. So we're going to talk, I'm going to briefly run you through derivatives in the next 10 or 15 minutes, and then we're going to dig into a lot of the code. So when we talk about derivatives, one thing that we should understand is the idea of a risk. And a risk is essentially any possible negative outcomes that can arise from when certain events happen. And there are two sort of measures that we use to measure the magnitude of a risk. That would be, the first one would be the likelihood of the event happening. So if it's very likely for something to happen, there's going to be a high risk that something might happen to you. And also how big the likelihood of how big the effects are that are likely to happen. So if there are going to be some very, very big damaging effects, likely it's going to be that your risk is very large. And what we normally do is we multiply both the likelihood and the size more qualitatively to give you an idea of how big the risk that you're dealing with in general. When we also talk about derivatives, we talk about something called a counterparty. So in a trade, you're going to have a buyer and a seller. In this case, we might be buying a derivative. The counterparty is the party that's on the opposite side of the table. That's why we call it a counter. It means the opposite. So in this case, it would be the party or the syndicate. When we refer to a syndicate, we're referring to more than one type of person that might be on the table for a business deal. The reason why we might do some derivatives is to do with something called hedging. Hedging is essentially when we're trying to minimize our risks. It comes from the old times where very rich people, when they used to have very big houses, would grow hedges in order to keep prying eyes away. Of course, we use it in a financial sense to try and minimize the potential for us to lose any money. And the risk that you gain from investing into an asset is what we call the exposure. So if I buy lots of shares or I buy lots of coins, I've got exposure to those shares and the coins respectively. I'm essentially exposed to the trade. I can make more money or I can lose some money. So it gives me some opportunity to get some exposure. And actually, using derivatives is for that purpose. We can also minimize our risk, but also increase our exposure to be able to make certain trades. So far, so simple. Now, how do we achieve the idea of minimizing this risk that we've been talking about for the past few minutes? Well, investments generally have something what we call an intrinsic risk. It's essentially a risk that's built into the trade. If I buy a coin, the most that I'll ever lose is the amount that I put into buying it. So if I buy a Bitcoin for say 10,000 or whatever, 16,000 US dollars, I could lose $16,000. That's my risk, because if it goes to zero, then I've lost all my money. It's what we call intrinsic, because it's unavoidable. If I buy it, it's always going to be there. Hedging essentially is the idea of minimizing the exposure to me losing money. And losing money in a financial sense is what we call capital loss, because when we talk about capital, we're talking about your own money. And of course, loss just means simply losing it. In this sense, a derivative is basically a contract which is built upon an asset or so that can help investors like myself, like yourselves, hedge the risk, so minimize the amount of risk, and also minimize the exposure. And what I mean by hedging risk, I should be more specific, it helps us to minimize the chance of losing our money. talk about contract. I think it's fairly straightforward what I mean by a contract, but essentially, just for your clarification, it's just a piece of paper that binds myself and another party, a counterparty in this case, to an agreement with specific terms and conditions attached. So you both have to be able to meet those terms and conditions, and if we don't, one of us can sue the other, hypothetically. And when I talk about financial derivative, I'm talking about a contract which basically works from basically deriving its value from an underlying asset. So it could be a crypto coin, it could be anything that you could think of in the financial world. The idea of an underlying asset is also something that may be quite new to you, but we'll briefly touch on it. You've all actually encountered an underlying asset when you've actually taken some car insurance, assuming some of you are driving a car. So what happens is you go up to an insurance company and you say, look, I want you to insure me in case I crash or die. So what you do is the insurance company asks you for the car that you're driving or the driving history and the driving history that you've got to make sure that you haven't been going around murdering other people. And essentially what happens is that they feed all that information into a model and then they use that information to give you a quote on your premium. And that essentially builds into the contract that we are given. So the underlying asset, the thing that builds the contract, is the car that we're driving and our driving history. If you're a big fan of sports bets are also what we know as derivative contracts. So we go to a betting exchange, Bet365 or wherever you may choose, and then we put our bet on a football game or a sports game, and then we basically look at the previous results of those teams and also how they fared in the past, and then we use that in the model of the betting exchange to give us an odd, 4-1, 3-1, or if you're American, I think it's decimals, and then that gives us the odds of the contract. So basically the chance that one team might win against the other, and henceforth to how much money you're going to get paid off. So that's obviously the idea of an underlying asset. So in the financial markets, we can sort of generalize that idea. So we have a contract issuer, the people that we're dealing with. We have the underlying assets, which are basically what builds into the contract itself, what it depends on. And then we essentially have the contract itself, and they sort of feed into one another accordingly. And the schematic that I've shown here generalizes most derivative contracts. Some may be more complicated than others, but you can generally simplify to this level. In financial markets, you'll cover mostly 4 different basic types. So you have forwards, which we'll cover momentarily. Futures as well, very similar, slight difference between the two. Options, which is my speciality. This is a lot more complicated, but there's a lot more, it's a lot more nuanced, a lot more fun. And swaps, which, to be honest, I haven't really dealt with myself, but it's fairly straightforward. So, unfortunately, some of the slides have clearly decided to evaporate. So, futures and forwards are very similar. It helps us to either buy or sell a fixed amount of an underlying asset, so whatever the contract is built upon. On the left-hand side, it's at a fixed price or at a fixed date in the future. And some of these would include currencies, commodities, and bonds. That's for the financial world. Of course, if we're working in crypto, it'd be more sort of crypto coins. When we talk about the fixed date in the future, that is what we refer to as the expiry or the settlement date. And when we talk about the price, the quoted price is how much that we pay for it, the certain underlying asset, when we get to that date. And that date essentially is when the initially agreed price is exchanged for the amount of asset that we want to buy. Because of the nature of futures and forwards, it actually, what it means is that the buyer, essentially if I'm buying a contract from one of you guys, I am forced into that deal. Whether that deal doesn't go very well for me in the end is none of my business. I've agreed to take on the contract, so whatever happens, I'm going to have to part with my money and exchange for the assets that I'm buying. Options, as you'll see momentarily, is when I have the option to buy those assets. So essentially, in this case, I'm sort of forced. The only difference between futures and forwards, in a simplistic sense, is that futures are what we call standardized. This sort of comes from the idea of a contract. So all the terms are the same, whether it's company A, company B, company C, all the way. All these businesses have to work under the same terms. They're all standard. All the terms are standardized. Forwards, however, are a bit different. They're what we call a custom contract. So what we do, we sort of trade them over the counter. Counter, of course, if you go into a shop, there's a counter where you deal with the shopkeeper, and you can set your own terms. That's where the term comes from. So essentially, the bottom line is futures are specific, so they have specific terms and conditions, whereas forwards are what we call custom contracts. So we can make it work to our benefit and make sure we can negotiate our terms as we want them. In the world of blockchain, some things may be slightly different. As I mentioned in futures, we have a specific fixed date in the future. In blockchain, that doesn't actually have to exist. We can actually take out a futures contract where the expiry date doesn't actually exist. The expiry date can just carry on and on and on. And this is what we call perpetual, because perpetuity, which is the verb that it comes from, means never ending. Perpetual futures, henceforth, do not have an expiry date attached, so they can keep on going on and on and on as much as we want them to. Since the expiry doesn't exist, there's something that we don't do, which is called rolling over. In these traditional financial markets, what essentially happens is that because you have a fixed expiry date, you have to, when you buy a futures contract, if you don't want that futures contract to expire, you have to exercise it. You have to then do the opposite, which is to sell the futures contract and close your position. So essentially, if you buy something and before it expires, you have to sell it so you don't actually lose much money. In the idea of blockchain, what you can do is you don't have to sort of roll it over. You don't have to do the selling. You don't have to do the opposite of what you did right at the start. So if I was buying a futures contract, I don't have to sell it before the expiry. I can just keep on going on and on and on. As I said, rolling over a contract would mean that you have to close your current position and open a new one. So you maintain that same exposure. Give you an example. If I had a future for 50 Ethereum coins, and that futures contract ended, say, by the end of next month, what I'd then have to do to maintain that exposure to 50 Ethereum contracts was I would have to close out that contract at the end of next month and then open a new one. So I'm always exposed to 50 Ethereum coins. In blockchain, because we have perpetual futures, we don't have to do that. It can just keep on going on and on and on because there's no expiry date. Swaps, there aren't actually I have never used them. I don't see much need in them in my sort of area. But they're essentially just agreements to essentially, well, in the word, swap things between two different parties. In crypto, we have an idea where we swap different coins. So what essentially happens in crypto is that you have to exchange your Ethereum into a standard fiat currency like a dollar, and then you have to then be able to buy the cryptocurrency that you want. So, but what we do in the idea of swaps is that we can actually swap the coins directly without going through the middleman. And that's the only real reason that you'd use a swap in the crypto world, as far as I'm aware. Just covering a bit of options. So options this is my area of expertise. So futures and forwards, where we were forced to actually trade the underlying asset. And the selling party would have to sell the underlying asset, and the buyer would have to buy. Sort of options answer the question of whether we want the option to trade the underlying asset, whether we are buying the options contract, and that is essentially what it serves to do. It gives me the right, but not the obligation, to actually buy or sell the underlying asset, buy or sell a crypto coin in my situation. They are still derivatives because they still depend on the underlying crypto coin, on the underlying asset that it's built upon. They are slightly more complex though. So there are two different types of option contracts that you will be encountering, and the idea of options is that you can choose to exercise it. So it's good for hedging risk, because if your trade is about to go bad, all you have to do is not exercise your options contract. You have the option to exercise it, unlike in the futures or the forwards where you're forced to, irrespective of whether you're about to lose money. Yes? Yeah. But with the option, you still have an expiry date, don't you, right at the very end, or run in the lead up to the option, whereas a perpetual future doesn't have an expiry date. So just to clarify for people in the Teams call, gentleman over there asked, what is the difference between a perpetual future and an option? So options still have an expiry date attached, just like futures and forwards. So there's going to be a certain point where that contract ceases to exist, and I'm choosing either to force to actually exercise it or not, whereas a perpetual future doesn't have an expiry date, so it can keep on running on and on until eventually I might choose to make an expiry date for it. Okay, fantastic. So, as I said, two kinds of option contracts are available. We have call options and we have put options. And in the case of options, because it's an opportunity for us to choose whether we exercise the contract, we have to pay a certain cost to the person that's selling the contract. They are essentially, in the financial world, they are quoted in terms of per unit of the underlying asset. So in crypto, it would be per Bitcoin, but we might be forced to buy 100 Bitcoins because it's standardized. So it might say that for every Bitcoin that you buy, you would pay say 5 cents for this option, but because we have to buy 100 Bitcoins per contract, we'd have to multiply that by 100, which is 5 cents, $5. So the first one we're going to cover quite briefly. So call options, essentially if I call my broker and I ask him to buy me something, that's I think where the word comes from. It offers me the buyer, as in myself, for example, the right, but not the obligation to buy the underlying asset. So it offers me the right to buy a Bitcoin, but not actually forces me to actually get it. So we have two different attributes. We have a strike price, which is the price that I buy it at, and we have the future expiry date. As I mentioned to the gentleman, the options still have expiry dates attached. So call options are beneficial when, for example, the underlier, so the Bitcoin, actually goes higher than the strike price. So we refer to the price of the Bitcoin, the price of the underlier, as S, and the strike price is K, because strike has K in its word as a letter. Put options are a bit different. I like to explain that when I have a put option, I'm putting something on the table for someone to take away from me. It's the opposite. It's the buyer has the right, but not the obligation to sell the underlying asset. So I could buy a put option to give me the opportunity to sell the Bitcoin at a certain price. Check if this still works. It doesn't work. Oh, it does work. Fantastic. So with a put option, we still have a strike price and we still have a future expiry date, an expiry date in the future, not to be confused with the futures contract. I apologize for the terminology. Put options are also beneficial in the opposite sense when the underlier, so the Bitcoin, actually falls below the strike price, because I could sell it at a higher price while everybody has to sell it at a lower price. So I make a bit more money than everybody else. This is sort of coming up to the end of my discussions. We'll quickly run through the end of it. So what we can do with options is we can actually plot our profit and loss. The way we do that is quite simple, is we first calculate the, oh God, right, this is out of order, but there we go. We plot the intrinsic value. So what we do is for each point for each possible price of the underlying Bitcoin, in this case, we subtract it from the price of the from the strike price itself. So, for example, if I'm looking at whether Bitcoin hits, if Bitcoin is 16,000, and my strike price for a call option is 14,000, then my value of that contract is 2,000, because 16,000 minus 14,000 is 2,000. If the intrinsic value, that's the value that the contract has to me, the extra benefit that it gives me, is less than 0. So, for example, if I buy a Bitcoin put option at 18,000, that's negative 2,000. I don't actually give it the value negative 2,000. I give it a value of 0, because in financial markets, anything with a value of 0 is essentially worthless. I wouldn't exercise that option in the first place. So there we go. A simpler example, just with smaller numbers. So if the strike price is 95, and I think for an underlying asset value of 102, it'll be 102 minus 95, £7. As I said, though, £7 isn't actually how much you gain from the option, because you have to buy the option in the first place. So you know that profit and loss is profit or loss is known as revenue minus cost. That's basic business talk. The revenue here is the possible value that I'd get, which would be £7, assuming that I arbitrage, so I sell it immediately. However, people in the financial markets are very smart, and they're going to try and maximize as much of the revenue that I could get as possible, because they know that this option is very valuable. So if the option, for example, costs £5, as they're trying to maximize as much of my revenues as possible for themselves, so they can take as much from me as they can, the overall profit, not overall revenue, my apologies, is 7 minus 5, which is £2. And then we can plot this for both the put and the call options. And in programming sense, to force the condition that if s minus k is less than 0, we use something called the max function. And what essentially it does, it looks at both the parameters that you apply. So you pass in 0 or s minus k, and it chooses the one that's bigger. So if s minus k is negative, it's going to choose 0 the whole time. It always chooses the higher number. For option contracts, so this I believe is a call contract. This is the profit and loss. So it's so at a strike of 95, I actually only just break even, so I only actually start making profit when I reach 100, because the strike is 95, but the cost of the option is 5. So I only start making profit when the underlying asset, so for example, if this is on an Ethereum coin or whatever, if only that coin reaches past 100, £100, $100, do I start making profit? It's very self-explanatory there. I'll actually just show that for the people in the Teams call, if I can't do it actually. So I've got a laser here. So if I go past 100 is when I start making profit, and it shouldn't be IV, it should be P&L. But if it's less than 100, then I make a loss of £5 because I don't choose to exercise it. So there are other notations available as well, as you can see on the far right. So IV is equal to max 0, S minus K. There are other notations as well. And the profit and loss is essentially taking that function and then subtracting the option cost. So revenue minus cost equals profit and loss. Same thing if I do a put option. This time it's sort of the opposite. So essentially it's still the same intrinsic value, but because it's me selling the option, the graph is sort of reflected. So now, if I'm selling if I buy a put option, if the underlier is less than 95, then I make money. But if it's more than 95, I lose money. If I sell the call option, if I'm selling the option itself, then what happens is that I actually only make money from selling the option in terms of the premium. However, if the call option falls apart over here, then I'm going to lose a lot of money here on the far left. The same applies over here, and the same on the call, because it's just the reflection. It's very self-explanatory. They're just reflections of one another. Assume Naman has arrived by now. So Naman, if you want to come over, this is Naman over here. So he's going to be talking about the next section, which is to do with the code. I'll be here as well, adding some of my remarks when possible. But other than that, if you can please give a round of applause to Naman, and he'll carry on with the next part.
Perfect. Hello, can you hear me? I hope you guys understood the first part. I will try to now explain a little bit more about actually writing some code to hook into Binance and execute some trades. But for the purpose of today's sort of session, I won't be doing anything on Binance, like the mainnet. I just doing a test net. So I think the best thing to do is to just sort of have you guys follow along, and I sort of walk through the code, and you guys can look at the code as well, ask questions about the code, and we can try to run it together. So here it is. Can you guys see that? It'd be best if you have it open on your screens as well. Now, I won't recommend opening on Gitpod because on Gitpod, everyone edits the same version as I do. But if you want to try to edit it yourself, you can do something like go to Colab, which is this thing. And then you can, so if you can open one thing. You can open a notebook. And if Imran puts the link to his GitHub repo in the WhatsApp group chat, you can just paste the link in here, and then you can open a new tab, and you'll be able to run this in Colab, your own Colab environment, that's how I know that you guys can't mess with my environment, but we can still run the same thing. So I'll let you guys do that for a little bit, and then we'll get into it. So if you have WhatsApp Web, that's probably the easiest way to copy it over from WhatsApp into Colab. And let me know if you have any issues. I tried doing this myself before. It worked all right. Maybe one or two cells might not work. I'm not too sure why. Maybe because of the uniqueness of the API keys, but otherwise it should be okay. I'm looking into the slides. For anyone who hasn't worked with Colab before, it's essentially Google giving you a container, like access to a part of a machine to run your code in. But each time the machine is sort of fresh, and you can put the dependencies on it. You don't have to worry about configuring Python or pip or whatever. It's just like a runtime container that has everything you need on it. A Colab Jupyter Notebook equivalent. Colab is Google's way to run Jupyter Notebooks.
Essentially, what you're doing is, rather than writing a whole Python file, is you can essentially write bits of code at any one time, and then save it, and the variables are always living around so that you can access them whenever you want. Unlike a Python file, like you saw in lecture 0, we have to keep on running it over and over again until you get the right result. That's essentially it.
Yeah, I think you use Colab because you don't have to worry about the resources you need to run your code, and you don't have to worry about maintaining an environment, which means that you don't have to worry about those messages saying pip not installed, pip version wrong, Python version wrong. That stuff's handled for you. You're just focusing on purely writing the code and looking at the output. Perfect. Can we try to share this screen? Or is it only the screen?
This is a screen that shows up to the PC.
Okay, fine, that's fine. There's a bit of code on automated market makers. I'm not sure we need to delve into that right now, unless you want to. Yeah, let's just get straight into the sort of using or trying to interacting with the Binance API.
I'm going to cover it for a few. So.
Yeah, go for it.
So, I mean, I will cut. I think it'd be best to just cover it. I mean, just because you're here. Essentially, the idea, as you can see in the slides, just to get back to them. So essentially, you have an order book, which is basically just buyers and sellers all merging together in one unique location, and all these orders have to essentially be filled. So they all get put into a book, and then, well, technologically, and then you have people on the right who are buying it, so they're bidding for it, and people who are asking for a price who are selling it. And then what happens is that you have to go through an exchange to actually get that done. Whereas at an exchange, you do need people to buy and sell. So you do need people that supply the stuff in the first place, and you do need buyers to buy it often. And that's what we call liquidity. And if you're a market maker, like Binance, you sort of bring the buyers and the sellers together so that you can make a market. So you can actually make the market is where people buy and sell stuff, just like a fruit market. But in the finance sense, it's more about bringing buyers and sellers of a financial asset, for example, Bitcoin. And the automated market machine, I mean, the fact that it's automated is self-indicative of what it means. It's done largely by computers. And essentially, they just use liquidity pools where they just pick up different people that want to buy and sell things, and they just put them all together. And when we use a decentralized decentralized automated market making, what happens is, in the most logistical sense, is they actually calculate the price of an asset based on supply and demand. The way they do that is by using the inverse relationship of y equals 1 minus 1 over x, because if you multiply x, y equals 1, so it basically equals to a constant. And that's what they sort of extrapolate that formula, and they use the xy equals k model. So k is a constant. And the idea is that if x goes up, so x is supply and y is, well, demand, for example, if the supply goes up, the demand must go down for the same value of k. So if x goes up by a factor of 2, y must go down by a factor of 2 for the same value of k. Correct? Yeah. So then, if you plot that on the graph on the far left over here, you can sort of see that relationship. So we increment the purchase of dx, which I believe in this notation is actually an asset A, and y being asset B. So if you buy asset A and you trade asset A and asset B, so you buy asset A, you'll obviously be selling asset B. What happens is that you increment the pool by dx, because mathematicians like to use notation of that nature, and then you also subtract a bit of dy. It might be the other way around, sorry. And essentially what happens is you can use this constant product market maker formula to work out the calculation of a price based on supply and demand. And there are also other things, for example, making sure you don't lose any money, which is impairment loss. And that's also mathematically derived, but for the context of this course in this session, which is probably going to cover the programming sense. Is that okay?
Yeah.
Fantastic. 2 seconds.
Fantastic. I'm hoping in that sort of time frame you managed to get onto this sort of notebook. If you haven't, put your hands up, and if you have, don't put your hands up. Okay, it's fine. Maybe the person next to you has, so you can look at their sort of joke. No. But I just want to sort of make sure that you guys can do this alongside me, so that any questions you have, or any error messages that pop up, we can talk through them together. The worst thing is if I work through this and it works fine for me, but it doesn't work fine for you. So let's start with pip installing everything. So you can just run this here. And what this is doing is getting all the libraries that we need to use to interact with our APIs. So you'll see, okay, when it says requirement already satisfied, it means we already have the library installed on our machine. or it's running this right here. Yeah, I think by the looks of it, everything is already installed. Essentially, the first two requirements are for us to interact with Binance to find out data about the market and how to place orders. And then Plotly is used to sort of render some graphs. Those are the main ones, I'd say. So let's look at what's happening. Okay, so this is our first little bit of interacting with the API. And we're going to try to actually get some data from Binance about a specific asset. So firstly, the way we do this is we import the client. So you can think of Binance as like a place where you want to get some information from, and they can be considered as to be our client. And we tell them which URL, where we want the data from. So we want it from a testnet because we don't want to actually execute any trades, and we also don't have any money on our Binance wallets in this sort of test environment.
I'll show them just one thing as well. A very big so when we sort of do import functions, lots of people don't tend to realize what that means in the context of what we're doing and what that sort of. So essentially, what you're doing is you're using Binance connector and Python. That's the package that you're using. It's basically a bunch of code that someone's built together on GitHub. I believe it's this one. So yeah, so what essentially you're doing on the first line here, Binance.spot, is essentially you're going from Binance to Spot, Binance.spot, and you're actually running this Python file over here, which is called the init. And that's where you get the import spot over here, because that's what the class that is defined. And essentially what's actually happening is that this class is essentially being loaded into your computer, and it's running in the background of your computer, which is why when we pass a URL over here, it's essentially actually running this URL for us, because if we don't pass the URL, we're essentially interfacing directly with Binance. And as well, what it's doing in the side is once we create a class, once we create an object, from this class, is it's going to run lots of these import functions to help us do our job. Just a bit of a clarity onto what we're actually doing when we import a function. And you can actually trace the path yourself.
Yeah, that's actually a really good point. It's always good to figure out what's happening under the hood if you're getting error messages you don't understand. And like, for example, it's really good to look at this sort of constructor for this Binance client class, which tells you that actually, if you didn't specify a parameter, you'd actually end up interfacing with the main Binance API, which is not a good thing. If you have a Binance account, you have API keys with your Binance account, and you're trying to mess around with some sort of like test trade or whatever. Okay, so what's happened is we've sort of said to the client that we are connected and we want to get some information on Binance coin against the USDT. So we make this request and we get a JSON back. So JSON is how data sort of flows from client to server. We are the clients in this case and the server is Binance. And here we got some information. I'll sort of walk you through what this is saying. Can you see this if you click plus on your own thing? Like if you click play on your own Jupyter notebook or your own Colab environment, has this come up for you? I'm going to assume if you don't say anything, it has. And if it hasn't, please say something. Like it's for your own, so good. So we have a time zone, we have UTC, and we have this server time. You might be wondering, why is this time not like, 5 past 11 or whatever times you used to see. It's because this is Epoch Time. So if you go to Google, you find out what this means. If you type in Epoch Time converter, and this is the number of milliseconds past 1970. If I actually chuck in this number into here, you can see that actually this GMT time is right now today at 6:53, 50 seconds, and however many milliseconds. This is much more exact than passing back like a rough time, because prices of shares and stocks and everything change so quickly that you kind of want to know exactly what point was it at a certain price point. So that's what we saw there. Okay.
The rest of it's kind of just.
Yeah, I mean, I'll kind of explain it anyways. Rate limits is basically the frequency by which we can request, I think, the price or the information on this asset class. And we have specific rate limits for orders and so on in specific time intervals. This is just sort of metadata, which you might find useful if you want to know about it, but I don't think it's too important. Okay, so here's a really important part of today's lesson, is setting up using API keys to interface with the client. So you might ask, why did I need API keys here, but not here? Well, because we're not actually doing anything with this information, which is like information you publicly get from Binance. You can go into Binance's website and type in the price for BNB. By having an API key, you don't need to. You're actually asking for more permission. So to maybe trade something, and to maybe trade on Binance, you have to log in, right? So the API key you can think of as your login details into Binance. We didn't need the API key before because we weren't really logging in to do anything that required our details. But now we're logging in, so we have to get a pair of API keys. And what this is essentially a key, which is like, hey, this is my name, and a secret, which is like, what's my password? You shouldn't really share this with anyone, the secret especially, because then they can go into your account and make trades off of your account. Imran has very kindly given us a pair of API keys, which I think are hooked up to like the testnet, so it doesn't really matter what you do with them. If you want to generate your own API keys, I'm pretty sure you can just type in Binance. Like,
there's a slide on that as well, actually.
Is it? I'll show you how to do it if I was doing it. Here we go. So I just essentially go to here, and basically it makes you log in, and you can create your own API key. And you can make multiple API keys if you're, say, working on a few different OSs at one time. Maybe you have a nice complicated setup. But fundamentally, you can only create an API key if you have a Binance account. And please don't share this key. It's almost as important like it's your wallet key. So that's how you go about doing this if you wanted to work. So let's say now we've got our API keys. We want to actually do something that requires elevated privileges. So something that requires us to be logged in. One of these examples is maybe making a trade if you want. But for now, we'll just do a very simple example of printing out the tickers, which are some assets you can trade on Binance, and their sort of price. This is okay. This is all sort of, yeah. So I think I know what you mean. So you're saying I'm importing clients here, import sport as client, and I'm also importing clients here. You can think of them as like overloading. So multiple ways to use a class. So in the previous context, we were using it just to sort of access information without an API key. In this context, we're using this client class to actually log in as our user to get details back from Binance. And you want to go this way once you are actually working properly with your API keys. The previous way was more just to show you very superficially how I can actually just get data from an endpoint. But good question. Please ask more. So we've got our API keys. Now we want to actually start making some useful requests and actually start making some trades at some point down the line. So to do that, we need two more libraries, requests and JSON. Requests are how we can actually sort of get data make some calls saying I want data from this endpoint, and JSON allows us to convert that data into a JSON format, which we can then break into sort of like table key value pairs and table column row format. So essentially, look, I got this data in this format. but I want to make some more sense of it, right? So I use this JSON library, which helps me make more sense of it.
To add to Naman's point as well, I'm sort of introducing a bit of computer science stuff, which might or might not interest some of you. Essentially, you can check if I'm wrong. Essentially, what you're doing is you're contacting a computer in where Binance's what you call a server. It's just a collection of many computers, and you're basically asking them, in this case, to give you some information. So essentially, it's the same idea as in the restaurant. You're asking for information. You're the client, and they're the ones serving you with the information. So they're the server. And basically, what you're doing here is you're requesting some information as the client from their servers, and that's why you're going through this whole hassle of importing other modules, is because the servers only accept requests in certain sort of formats. You can't just write any random old bit of code and expect the server to get back to you with the information that you want. You have to oblige with what they want, and that's why we're importing JSON, because JSON is a computer science friendly sort of way of requesting information from servers all around the world. It's normally standardized in that way most of the time. And as Naman will mention, so you provide a few bits of primary information called headers. It just basically says what you want, and then you also just supply it with the information that you're looking for. Is that correct?
Yeah, I should probably ask, like, I haven't actually asked, what's the sort of competency level? Have you guys coded in Python before? But yeah, show of hands if you have coded in Python. Oh, perfect. Have you hooked into a sort of a API before and made requests to an API before? Okay, cool. So I'll slow down a little bit. I think I was going a bit fast. Yeah, exactly as you just got told. You know, what's happening here is we're trying to get information from somewhere, but this information is hosted by a company that's protected it by sort of a firewall, and use the API to get some information from them. You can't trade if you don't know the price of the asset you're trading, and you can't tell the exchange if you want to make or sell the asset. So we have a URL here, which is a specific endpoint where we get information from. If you ever have any sort of concerns about what your endpoint to use, just Google Binance endpoint to make a trade. This is basically, so when you're using APIs, what's actually often happening is I'll just give you an example. You're just sort of basically making requests to lots of different websites. So if this is my website, this is what comes up if I just type it into Google, and you see nothing will really come up. It doesn't have a UI per se. Now, if I try to request more information, what I really do is I just sort of add in more sort of parameters to my request. For example, I want to find the price of a ticket. So what really happens is this gets compounded, and it just adds on to the end of this, and I get some more information. And here you go. So you can see I've sort of bypassed Python, and I've got this information by just typing this into the browser. The reason we use Python is because then we can actually get this information onto our machine and work with it nice and quickly. Whenever you see curly brackets like this, that's a JSON. So you have to import JSON to deal with that. And we can use Python to make this look nice and friendly. Like right now, there's probably lots of information that is, it's hard to make sense of. Python makes it easy to look at it using, tables or charts, and it makes it easy for us to quickly gather what we want to know. This is not very useful, as you can tell, but this is what Python's doing under the hood. It's just reading this web page essentially, which has all the information we need to have. Headers are used just because it's a way to tell the machine it's me making the request and how I want that format to be. And then this response is essentially just this information passed as a JSON. And then we can also convert that JSON, which is like that file with curly brackets, into a data frame in pandas. Do you guys know what pandas is? Yeah, so it's like a nice way to look at data. Okay, so here we are, everything I told you. So we have our URL, we have our endpoint, we can run this, and essentially we can turn everything I saw here into a really nice table. The bad thing with Colab is it requires you to run every single cell in the order that you define them. Otherwise you get error messages like API key is not defined. because I missed running one of those cells. And here you go. So I have all this information, but now as a table, which is what I want to see it as. So we can like verify that by looking at this page. Let's look at one of these items. So the fourth item is Neo BTC, okay? And if I look at my table, I can see the fourth item, a third index by zero indexing, is Neo BTC. So that just is a proof to you that we've got this information, we've got it into a table. That's really good. Now we can start doing some fun stuff with this. We can try to open a trade. So you're going to open a trade because you have a reason to open a trade. Maybe it's because the strategy told you to, maybe because you've had some insider trading, or maybe because you want to buy something. So to open a trade, we once again get this client library. We give it our sort of API keys. We say we want to run on a testnet. It's really important, always pass this in as a parameter. I'm pretty sure if you don't, it might assume you're on the mainnet, and then you might actually lose and gain money. So let's look at the balance we have of these assets, which is, I think, how much we hold of them, right? Free is, how much we can sell and trade. Locked is if it's staking, or, if it's it's a form that we can't actually trade on it right now, if it's not liquid, okay? So let's say, oh, look, we're very rich. We have a lot of BTC, so, we're doing well. We have lots of BUSD. We have lots of ETH, so this is quite a wealthy sort of account. So that's it. And let's try to put in an order. Let's say we want to buy something, okay? So let's create a name for it. Let's say it's a buy order limit. We interface with our client class and use this create test order function it gives us. And let's try to buy some Ethereum. We want to buy it. We want to buy it at a certain price point, if it's available in the market at that price point, and we want to specify how much of it we want to buy. So let's say you are staking some Ethereum to make it into ETH, or you're staking something which is like putting it away, and they use it in the consensus mechanism to make some more of it. It means you can't get it out straight away, so it's locked. And whenever you sort of have the option in Binance to lock staking, you should remember that if it's locked, I can't get it out straight away, or else I lose my interest I have accrued. Okay. Okay, sure. So we'll skip past making it a test. I think it's quite well commented, the code, so you can sort of understand it yourself. Even though I'm skipping past this stuff, I'm still going to run all the cells because I might import some stuff or define some variables, and I can't see those earlier. So let's skip past this. Skip past this. I hope it makes sense. If it doesn't, just pop some message or something in the chat. Okay, here we go. This looks more interesting. Searching market data. Okay. Maybe we need to pick up from Imran. I know I went quite quickly, so if you have any questions, please ask now.
The part we're skipping is we're using like the Binance's testnet API to get like market data, and then we realize that the data quality isn't the best. And because like the purpose of this session is to backtest some basic strategy, it's fine if we just use Yahoo Finance, which is like the largest finance API for pulling financial market data. And there's like a quick primer on Plotly because we're going to be using Plotly to plot the candlestick chart. So have a read of that when you have time. But like essentially all you have is you create a figure similar to matplotlib. And then instead of the axis object in matplotlib, you have like an add trace method that you can call from the figure object. And so that's how you add plots onto a figure. And then you just have like some formatting stuff via the update_layout method, and then you show the plot. You see a plot like this. Yeah, I'll let Naman take it from here. Yeah.
Oh, nice. So Y Finance. I think you might have seen that as an import earlier on. It's another library. It has lots of information, and especially useful for us. It has information on Bitcoin, which is something we have lots of historical data on, and we can nice and easily backtest our strategy. So backtesting is when we come up with a strategy and we run it back over the historical data to see if it actually made money in the past. Because if it didn't make money in the past, it's not going to probably make money in the future, unless you found some sort of edge. So every strategy you come up with, you should backtest it, and you should be like, every company which has quant researchers like Jane Street or Optiva, a lot of the quant researchers' job is to break a strategy. So by that I mean, let's say I come up with a strategy which is, I want to sell Bitcoin on the first of every month at 12 o'clock because I've seen for the last 10 years it's dropped in price. Okay? So let's say that's the strategy I come up with. The purpose of a quant research or anyone is to make sure that this strategy is actually going to make you money, right? And often what we find is that correlation does not mean causation, and a strategy like that will make you money 9 times in the past, but the day you open your trade, you're going to lose all your money. So please, backtest your methods. So what's happening here? We're getting some information on BTC. And we're going to get some. What does this do? Let me have a look. Just want to see what BTC is. So essentially, we'll get data on Bitcoin in terms of historical data. What price it opened at, what price it closed at on a day, and highs and lows, etc. Okay, yeah. So I wanted to print this out. It's just an object from My Finance, which contains information about its history, etc. So BTC here is an object of the ticker class. And here we have, it has lots of properties, it has like history, and with history we can actually sort of get more information on it. So here we got the price of Bitcoin from 2019 on these days. And it's fine to have old data because it's historical backtesting we're doing. And we know it opened at, say, $3,746, and it closed at $3,850, right? It was higher that price even. And it closed 3,843. So you made money on that day, for example. And it traded quite a lot of volume. So let's have a look at what this looks like on a candlestick chart. And it's complaining because I don't have Go defined. It's because I haven't imported Go. So Go is, I think, Imran's name for Plotly. Yep, here. So make sure if you see any of these complaints, just Control F the word it's complaining about, and just make sure you click Run on each of those cells. I can try this again. There we go. It's running now. You can see it's taking some time. And we should see a chart, a candlestick chart of Bitcoin's price. So whilst that's loading, I will start talking about moving averages. Oh, here's our chart, by the way. So this is the price of Bitcoin. As you can see, it's doing pretty badly right now. This is sort of you can say like the period of lots of hype. And we want to find out that if our strategy made money across last 10, 12, however many years. So let's talk about moving averages. A moving average is how you can take an average over a continuous data set. So you can have varying time frames, 7, 30, 50 to 200 days. And it's sort of like, I can take the price, let's say the close price, over the past 7 days and average it out.
There's a slide for this as well, actually. Just you can type it in these days. There you go. If you actually, Ahmed and Naman was explaining, and he'll continue after me. So the moving average is basically when you average a certain number of days, and then you move that window across. In this case, it's down rather. So if you look at the first 3 days, the average of that is 110. That's the window that you collect all the data points from, and you average all of them. And then that window moves, so it's the next 3, and then the next 3 after that, so 110, 130, 100. And what the main purpose of a moving average, as far as I'm aware, is that it averages out all these sort of spikes and the volatility in the data, so you get a more representative idea of how in this case, the price of Bitcoin was moving in that window of time. So the reference to moving window or moving average is just the idea that you've got a window, you've got a selection of data in a window, so you can see it, and then you're just moving it along, in this case downwards. You can do it from left to right as well. But now we'll just clarify that a bit more for me, please.
Yeah, I think the time frames are a bit wrong on this slide. It should be like going forward, increasing in time. So like the dates, like you start in the 5th, you start in May, and then you jump to September and October, and you jump back to May. But you get the gist. So we're going to make a strategy based on moving averages. It's like a very easy strategy to come up with, and we can see if it works or not. So we're going to get the moving averages. We're going to get them for the past sort of 7, 30, and so on days, and we're going to look at how that looks like on a chart. You'll see that it flattens out a lot of the volatility, especially over longer time frames. You just see trends, so you can see the Bitcoin trend is going up and has come down a bit. And a very common strategy is to look at crossing of moving averages. I think, you can find out more about whether there's been past correlation in terms of does it actually have a statistical edge or not, but this is a strategy we're going to play on. So we're going to look at specifically the crossing of the 50-day moving average with the 200-day moving average, which we consider the golden cross. And the golden cross is when the 50-day moving average moves above the 200-day moving average. So if you think about that, taking a step back from all this sort of Bitcoin stuff, what's happening is we're saying over a period of 200 days, we have seen a price point. But we find that in the last 50 days, the price point has on average been higher. So this tells us there's a sort of trend in the price moving up compared to the last sort of year, okay? So in the last 2 months, we've seen the price go up compared to the year. And this is something that we think we can trade on and make some money off of. It might not be the case, but it's a strategy. And vice versa, if we see that in the last 2 months, the price has on average been lower than the price in the past year, we think we should not enter this trade, for example. So that's the strategy. It's the 50-day against 200-day moving average. And let's try to make the strategy and see if it works. Okay, this is very nice. So we have our strategy. We want to see where the 50-day average and the 200-day average cross, right? I'm going to get a sign of it. So we want to know if the 50-day is above the 200-day or below it. So we can get these crossing points, and we can look at them on our chart. And you can see them here. So we can see at certain points, we found the averages to cross. For example, in this case, we have a death cross. But here we have a golden cross. And we've seen, okay, death cross has resulted in the price going down for a bit more. After the golden cross, the price has gone up a bit more. And here's another death cross, and so on. I think you get the gist, right? Any questions if you don't? Okay, so that's our strategy. Let's trade these crosses. And we trade some more. What's happening here?
Yeah, do the exponential.
There's another moving average. I think there's lots of moving averages you can play around with. You can play around with specific, like, 50-day, 70-day exponential, and so on. It's up to you to go and try out and investigate some moving averages and see if you think you have a idea. So an idea could be if I see the exponential moving average be below the 50-day moving average and be above the 200-day moving average, I want to make a trade. So find out, play around with these averages, see what the numbers are coming out like, and see if you come up with a strategy on how to make a trade. Yeah. Cool. So then we can have a look at the exponential moving averages and see if we find any crosses. Oh, there's a cross here on top of these averages. And here's our strategy. Okay, so let's try to implement a moving average strategy. Let's have a read of what this says. So this is saying exactly that. So if the 50-day moving average on a specific day is more than the 200-day moving average, why are we in a position column? Okay, and we haven't actually got any of this asset. We can then, I think, place a buy order. And the vice versa, if the 50-day moving average is below the 200-day moving average on a specific day, the I is your day, I think, or yeah, then we don't hold this asset, then we can sell it, or if you hold this asset, we can sell it. So this is essentially the if statement encapsulating the concept of trade where 50-day is above 200, or sell if 50-day is below 200. based on whether we actually hold the asset or not. Like, you can't sell if you don't own anything, and we can buy if you do not own anything as well. So we create a column for this daily price change. We calculate our returns. So let's say this is our strategy. We want to see what we're making in terms of our returns. Okay, clear our position. Yeah. Okay, cool. That's worked. Yep, fantastic. Let's plot this out. Okay, I think we plotted them. So our strategy was to, I think, buy and hold. And our returns are...
What I've done is I plotted the buy and hold. So if you just bought Bitcoin in January 2019, this is what your returns would look like. So if you held it to today, you'd end up with 337% returns. Then you can see here the MA crossover strategy that we've implemented is pretty flat compared to that. And so this is an example of where the strategy isn't like really optimal. Then I've just like calculated a few more metrics like maximum drawdown. So what's the maximum you've been down through implementing the strategy and comparing it to buy and hold. And you can see that even though the performance is kind of stagnant, your maximum drawdown is kind of small compared to your buy and hold strategy. So it's just some things to keep in mind when you're managing risk. And we'll cover this in 2 sessions time way more extensively. And then I've just calculated like the annualized volatility. Again, we'll cover this again like in 2 sessions time. And just as a bonus, I implemented, instead of the 50-day moving average and the 200-day moving average, the 30-day and 50-day moving average. So same logic here. We plotted out the same, and then you can see it generally performs better. And then just for the sake of completeness, I've coded out the same risk metrics. I've coded out the same risk metrics again, and you can see it has a slightly higher. So it's like just has a slightly higher maximum drawdown. So it's just conveying the idea that the more risk you take, the more risk you take, the more potential reward you can have, but you also have to take on that risk. And so there's a higher maximum drawdown. And then just again another bonus plotting order book depth. You can go through this in your time. But yeah, I think that covers.
Yeah, I mean,
So that's pretty much it for this session. So if you can please give a round of applause to Naman.
thank you.
So apologies for any sort of inconvenience that we may have caused. Next week we'll have another session from one of our sponsors, GSR, which we've come to. We'll do a few more other things as well. I'll do the Amazon codes momentarily because we didn't go much through the slides, but I'll flash them on the screen. There's some pizza, so please come along, choose what you want, and help yourself. So thank you very much. At the end. Discarded. There.